Some of you have been asking me if I think 5-year bond rates or yields are going to move lower from here, which would obviously drag the mortgage fixed rates lower as well. It's really hard. Let me try and explain it this way. So the way the bond market works, it's all based on future expectations of inflation. I mean, obviously supply and demand from investors for those bonds evidently plays into that, but their demand for those bonds is based on where they think inflation is going to come in over the next 5 years. And so when we think about where inflation is going to come in, you have to think about what is going to be the strength of the economy, because the strength of the economy drives inflation from the demand side. The other side is from the supply side. As we saw during COVID, when the supply side gets disrupted, you can also have inflation. So thinking about inflation and the growth of the economy from the demand side, you have to think about what is currently priced into the market and what is not priced in. And I think right now, what is priced in is that there's some inflationary pressures, mainly coming out of the US with regards to tariffs. However, those appear to be passing through without any major issues. And at the same time, the job market is weakening, the economy is weakening, which is why we saw this latest move lower in rates and even variable rates, with the overnight rate getting cut from the Bank of Canada. So do I see the fixed rates moving lower? I do, but there is going to be an opposing force from the bond market in the US, because there is this underlying belief that what the Fed is doing is not justified, and that with the onslaught of more treasuries being sold in the US to raise money to fund their deficit is going to put upward pressure on US yields, which will obviously put upward pressure on Canadian rates. And so that is kind of in the background, the opposing force. So you have a weakening Canadian economy, which should drag mortgage rates lower, fixed rates. But on the other side, you have the threat of higher rates in the US, the 10-year and the 30-year, which will act as an opposing force for Canadian longer dated rates. Okay, so those are the two things. And really, it's a tug of war between those two things. Which one wins out will really depend on, does the economy in Canada get much worse than is currently expected? And does that force that I mentioned south of the border kind of subside? It's really, like I said, it's a tug of war between those two, and which one wins out will really determine whether or not fixed rates in Canada move lower from here. I think the weakness in the Canadian economy will win out, but the opposing force that I mentioned south of the border will reduce how much the fixed rates can move lower. I think the variable rates will outperform on the downside, meaning that variable rates will go lower than fixed rates. But I do believe that both of them will go lower from here into the end of the year. Take care, everyone.